Thank you. Am I starting now? Okay, cool. Cool, hi everyone. So my name is Jonathan Hollis, and I'm, as mentioned, one of the partners at yYur Ventures. By way of personal introductions, I spent about 10 years at PwC launching their corporate accelerator and then their fundraising practice, and left about 2 years ago to build and launch a new company, yYur Ventures. And as mentioned, we work with funds, we work with founders on helping them raise capital. And today I'm going to be talking about the term sheet report and survey that we ran last month, and we published our results a couple of weeks ago, and then also touching upon what it takes to raise your Series A round of funding. Is there a... here, cool. Thank you. So, here's a selection of the investors that participated. We had a wide selection across Europe, so all across the UK. Of course, in Poland, we're in Warsaw today. And the types of funds that we analysed ranged everything from VCs, VCT, EIS funds, which are tax-efficient funds in the UK, including CVCs and also, of course, angels and angel groups. Hi. In terms of the AUM between them, they've all invested 11 billion between them, and they do typically around 1,000 deals per year. Some of the results in terms of the valuation suggests that between 2011 and 2021, the average pre-money valuation more than tripled, which shows, I guess, the appetite for investors investing over the last decade. So what does the term sheet report show? Well, we first of all examined what a typical term sheet looks like, and we broke it down into 4 key areas. The first area being valuation and the typical terms. The second area being some of the deal conditions, including what's required from an investor's perspective. The third criteria being control, and the fourth, the binding terms. And what we thought we'd start with is what makes a term sheet market. And so on screen you can see the type of typical terms that the majority of investors asked for. So we analysed what the most common term was from an investor. So starting with preferences, the most common term was 1 times non-participating preferences, which means that upon a liquidation event, the investor gets at least their money back. The second most common term, looking at fees, so this is always quite a hot topic for many founders, and what we found was that the average fee taken by the investor to the investee company as part of the fundraise was between 1% and 2%. And we also found that the majority of investors recharge their legal and DD fees to the company. In terms of board seats, we found that actually board seats were required for Series A, but preferred for seed and Series B. In terms of an ESG clause, there was no expectation of ESG clause or sustainability. If I recall, something like a third of investors asked for ESG. The exclusivity period was about a month, and there were no indications of personal guarantees. In terms of founder vesting, now this was one of the more contentious topics, and there were a lot of different options for it. The most common option for founder vesting was a 4-year period, monthly, with a 12-month cliff, which means that if, as a founder, if you're looking to receive investment from VCs, you're looking at effectively giving back and giving up your shares for a 4-year period, with a 12-month cliff, which means for the first 12 months you don't get those shares, and after 12 months you get the full year back, and then beyond that, over the next 3 years, you then get them back monthly. And the reason why this is always a hot topic is because, of course, if you've built a company, it's always difficult to see that companies actually have to give part of their shares back. In terms of ratchets, so we found there were no equity ratchets. Tranche funding also depended on the circumstances. The share options, and so interestingly, both across seed, Series A and Series B, the most typical share options was 5 to 10%, and then there were also no growth shares. So the founder vesting was one of the areas that had the most variance. So as you can see, there was no single answer, and the other category had at least a dozen different answers. And what this shows that founder vesting is still a very hotly negotiated topic, and there isn't a market approach for this area. And you can see, however, that it's pretty clear that most investors ask founders to reverse vest over a 3 to 4 year period. Fees, which is also a hot topic. So on the fee side, we see that around 33 funds or so asked for no fees. 20 asked for less than 1%, but you can see that the most common output for fees was between 1 to 2%. And so these are the fees charged by investors to the startup companies. And the 1 or 2% typically involves recharging the legal and DD fees back to the companies. Some charge a lot more than that, so 3, 5, 7 to 10, 14%. It's likely than the ones charging 25 and 50% were providing some form of equity for services. And you'll have heard this morning a great talk from Diana that she talked about media for equity. And so that might be the case where if an investor's charging 50% of fees, it might be that they're providing services or operations to those organizations. So the implications, and I'll jump back onto the market slide. So the implication of the report really was, if you're a founder fundraising, then it's important to understand what the typical term for that an investor might ask for. And if you're a investor, the implication is, how do your terms compare with what's market, i.e. the 1 times non-participating preferences, the 4 years found vesting, the 1 or 2% fee-based. And so it's an important bargaining tool for those investors and those founders when they're having those conversations with the funds. And the reason why we decided to run it is because the analysing the terms hadn't been done before from specifically the investors themselves. Now, a little bit on preparing for Series A for founders. So we typically work with companies in preparing for their institutional round, and I'll touch upon a little bit what typical documents we see and what we recommend them to use. So we look to break it up into 3 different levels. So the top level, level 2, and level 3. And the top level is like the shop window when you're out there presenting your deck and presenting your pitch, and you're in the market and you're trying to generate some attention with those investors. And that typically includes the pitch deck and the product demo. In the current environment, we're seeing a lot more product demos because, of course, things are more remote. And we see even B2B companies with a product demo, which might be a dashboard, it might be a video of how the client experiences to really bring the product to life. Typically, that's done via Loom videos. So that's your top level. Once you've generated that first stage meeting, we typically then recommend companies to have prepared level 2, which is your investor FAQ, which typically involves looking at your traction, your market size, your competitor analysis. And that's because majority of investors in our experience, that's the first thing they ask for. And so if you're prepared from a founder perspective, when you're raising capital, and actually you've got some of these answers already in your documentation, the impression you give, of course, to investors, and the investors in the room today, I'm sure will appreciate that, is that actually they're not the only investor you're speaking to, and you're starting to build competitive tensions. And then the level 3 is your data room. And then we also recommend a good CRM tool for an investor tracker, and then also a good investor update email template. I'll skip through some of these. Cool, so the next takeaway I want to talk about is the types of funding. And I think this is an area that's relevant both to founders and investors. And we heard earlier this morning of the different types of funding across the business lifecycle. But one of the things that we're seeing, especially at Series A stage, is actually that the types of options available to companies are becoming larger. And there's a lot less discrepancy between stages in terms of types of funds. And therefore, what's really important is to really understand the different types of funding and how those investors might think. And so take, angels and high net worth individuals. You'd have thought that angels might be specifically relevant for very early stage companies, but actually even at the Series A, Series B stage, especially if you're looking for bridge funding, you might rely either on your existing investors or on angels to come and bridge the round, and that might be through a convertible loan note or an ASA. In terms of family offices, this is always an interesting topic given how private those investors are. And as well as working with founders, we spend a lot of time working with VCs. And of course, most VCs want to access family office money when they're raising their own capital. And the way that we typically break down family offices is through two different approaches. First of all, we look at the generation of a family office. So is it first generation, second, third, fourth, etc.? And we find that, of course, the first generation family offices are the entrepreneurs who've built a business, been there and done it, and therefore are much more likely to invest in companies and have a much more entrepreneurial mindset. And as you go down the generation, the family offices typically become much more asset allocators rather than asset generators and money generator. They want to effectively preserve their wealth. So they're not looking to create wealth, they're looking to preserve it. And therefore, when you're pitching to a family office, be it if you're a founder or a fund, it's really important to understand where they are from that generational context. The second interesting observation we've seen is the how big the family office is. So it might be a multi-family office, or it might be a single family office. And typically, you can associate a single family office with an angel or a family office. The biggest difference between raising capital maybe at the seed and Series A, and also if you're a fund, is that when you're raising capital at later stages, you're raising capital from people that don't own the capital. So you're effectively convincing someone who's then convincing someone else, who's then convincing someone else. And this holds true for family offices. However, this holds more true for single family offices because you're convincing that one individual principal like an angel. But what we've seen is multi-family offices operate much more like funds. And so if you're a founder or an investor and you're speaking to family offices and you're speaking to a multi-family offices, the conversation is going to be very different because the process will be different, the decision makers will be different, and it's unlikely that you will ever meet or speak to a principal. So those are the two ways that we look at family offices. And guys in the room, feel free to jump in and ask questions if you'd like. Given there's a few more investors, I'm going to tailor it to both funds and founders. The third interesting aspect we find with family offices, and this is more relevant to the investors in the room, is that fundraising is tough for everyone, both founders, startups, etc. But you often forget that when it comes to family offices, 99% of their wealth is not spent exploring deal flow, whereas 99% of the time VC spend is spent exploring deal flow. And therefore, when you're speaking and pitching to a family, you are less than 1% of what they care about. You probably don't even feature really in how they look at the world. Whereas if you're a starter pitching to a fund, you are all they care about. And that's often gets missed because if you're speaking to a family office and they've got $1 billion under management and you're pitching them for a couple million, they're not gonna care. And so how are you generating some of that interest? Well, by pitching something they're interested in, but they're passionate about, or maybe something that it relates to their core business. So this third point is something that we see time and time again, because and that's why it's so difficult to raise as an emerging fund, because you're typically raising from family offices, and the family offices you're pitching to have absolutely no interest in doing this full time, because it's such a small part of their day-to-day life. Then looking at listed funds. So the mentality with listed funds is mostly a UK phenomena, although there have been some listed funds now across Europe. So the likes of Forward have listed their vehicle recently. Augmentum VC as well, which is a fintech fund, have listed their vehicle. And there's also a large portion of listed vehicles in the UK called VCTs, which benefit from tax-efficient money, whereby if you're an investor, you then get 30% back of your investment in terms of reducing your income tax liability. And so when you're pitching and you're speaking to listed funds, of course, you've got to understand the time frames that they work in. And in the UK, for example, for VCTs, they typically work on a 3 to 5 year time frame. Now, venture capital funds, I won't go too much into too much detail. A lot is being said about them and how they operate, and I've got a couple of slides a bit later on that. Corporate venture capital funds, we don't normally recommend companies to get investment from CVCs in the early days, because often that dictates where they go during their journey, but they can be really interesting vehicles for Series A or Series B companies. And the advice that we normally give to founders when looking at CVCs is to analyse the rationale for the CVC entering, which sounds obvious. But when you dive into it even more, the three main objectives that we come across is, the first one is financial. So is the CVC not really a CVC? It's more of a spin out, like an Outward, which spun out of Investec, like a Mauro, which spun out of Santander. So the first thing to think about is whether they're a financially based CVC. The second aspect to think about is the strategy. So the value that you can get from the CVC, which might be that you're leveraging their customer base and the value they're getting from you, i.e. leveraging their software. And the last one is probably the most important one, is the fear factor. Some CVCs might simply want to invest in a startup because as their stock plummets to the ground, the startup's value might skyrocket. And therefore it's a bit of a risk mitigating factor. And it's more out of fear than out of strategy. So those are three things to think about. Yes?
Do you see CVCs asking for some specific rights when they are startups?
Yes. So the main right that we see them asking for is options, call option, an option to buy the company at a later date. That's probably the most significant right, because for later stage investors that might put them off, because they might think, well, you're pegging the valuation with this particular company. Or it might be a breath of fresh air, because you might think, oh, great, this is a guaranteed exit in 5 years' time. And depending on your appetite as an investor, where you are in that journey, you might see that as a good or bad thing. So the call option is the main right, and then there might also be a right of first refusal, which goes above and beyond their preemption rights, which again might put some later stage investors off. Equity for services was covered this morning in some detail by Diana. I learned quite a bit about media for services. I guess my additional points from this morning is a bit more about the legals. And so in the UK, for example, typically if you're taking equity for services, you've got VAT to pay. So if you're raising 5 million in equity for services, you've got £1 million cash, which you might need to pay as the founder. So if you've got no capital, you've got £1 million to pay, you're in a pretty difficult position. And second of all, it can work really well. So we hosted a CVC drinks a couple of months ago in London, and one of the conversations we had was with a company called Capita, which is one of the equity for services company, corporate. And their model is they take a percent of equity and they provide people and operational. And they were telling us that actually a couple of their companies had done extremely well from this arrangement, because I can't remember the exact percentage, but a large majority of the revenue that had come in the last couple of years had been as a result of the introductions from that CVC. And therefore, if you're giving away 20% for 10 people to work with you across an organisation for a year, and those 10 people generate 10x the revenue that you were, then clearly your 20% is worth the 10x return. Crowdfunding, again, it's on there because even at Series A or Series B, crowdfunding can be an excellent way of generating capital. I won't go too much into detail. I'm sure you're all well accustomed to what crowdfunding is. Revenue-based finance, Flavia earlier talked about revenue-based finance. This has completely skyrocketed in the last year. Something like $500 million in Europe has been generated and has been raised from revenue-based finance. I think if you look at the graph, it's crazy how it's just catapulted in the last few years, and that's generally because Europe follows the US, and the US did that 5 to 6 years ago. The big ones are companies like Pipe. If you've been on LinkedIn, it's hard to avoid Pipe with all their marketing at the moment. Clearco, Outfund, and then also Uncapped, which was run out of a couple of ex-VC guys. So this is an excellent way of generating capital, and high level. If you've generated 6 months of data, if you're on more than 10,000 a month, and if you're a software business, you'll likely qualify for revenue-based finance. And roughly, the numbers from what we've seen is you can normally take out 30% of your year's revenue. So if you're, £1 million run rate, you can take out 300,000. If you're 5 million euros, you can take out 1.5 million euros, which is a sensible amount of money. And then, of course, you then pay that back depending on your revenue growth. Venture debt, again, why is it on there? Well, because Series A companies can absolutely raise venture debt. Why? Because what matters to venture debt providers is two things. Well, one thing really, can you service the debt? So, can you service the debt? You've only got two options. Either you're profitable, in which case you can service the debt, or you've got a big VC in your books that can service the debt and it reduces that risk. So why is it relevant for Series A and B? Well, if you're raising a big Series A, or if you're profitable, then great. And what we've seen typically for venture debt, as a rule of thumb, is about a third of the total funding round. So you're raising 3, 1 mil comes from venture debt, and 2 million euros comes from equity. Loans and asset-based lending. Asset-based lending has also shot up, much like revenue-based finance. It's generally not relevant unless you've got something to show for securitization. So this might be computer equipment, it might be assets, inventory. It's something that you need to show to then borrow against. And then the last one is grant funding. Just talking outside earlier to a company that just got a grant, which is great. And these are very popular now across Europe through all the different schemes. So those are the. Sorry? Yes, it's just free capital. I think the only issue with grant funding, I think there's only one really. It's the amount of time it takes to actually get it. It could be a pretty long and painfully slow process. Sorry?
You've got no certainty of winning that grant because it's all... Sorry.
It's not heard on stream, so it's better to use the mic.
Sorry. I was just going to say there's no certainty. You can spend sort of hours and hours and hours filling in the grant application, and then you might not win it. You've probably got somewhere between 4 and 25% chance of winning one.
Absolutely. And I think that's the only cost. And the bigger the magnitude, the more the cost is. And the cost isn't just the time cost for the founders. It's also the compliance cost and the monitoring costs once the grant has been given. However, if I'm going to spend a month for €1,000,000, I will spend a month of time for €1,000,000 if there's a 10% chance. Would I? Probably. Cool. Any other questions on the source of funding? Went through. Yes.
Does cryptocurrencies can be asset that I can borrow based on, or you don't do it in Europe? Because I know in US there are some companies like that. How about Europe?
I could guess, but I would be guessing, and I think I wouldn't want to give opinions and sort of facts. So it's not a topic I know much about. But in the US, yes. In Europe, I don't know. Great. So that's the first. We talked about the first key takeaway, which is what to prepare and what the investor readiness documents look like. The second takeaway is around the types of fund and the source of the funding. The third key takeaway is around empathizing with funds. And given there's a few investors in the room, I won't go too much into this detail, but this often is when we're speaking to founders, most founders are unaware of how funds work. They're unaware that VCs are raising from predominantly us, the taxpayers. Most founders in a room like this, if I'm asking them which is the biggest source of LP money, they've got no idea that it's themselves as taxpayers, because the government, of course, is the biggest LP in Europe. And most founders are unaware of that, especially for emerging fund managers. And so often we explain how the LP ecosystem works and how the mechanisms for reward are calculated around the management fee and the carry, because it explains a lot of the reasons why and how the typical fund cycle works. And we also go on to explain that most funds take 2 to 3 years to fundraise, whereas most founders might take 6 to 9 months. And so the importance here for many founders is they are often, and for the founders in the room and the founders listening, the key implication is you might be speaking to a fund, and what is a fund? Well, it's just brand, access, and capital. And if you're speaking to a fund and the fund is raising, the only value they have as a fund is the access to you as a founder. And therefore, it's good to always be wary as a startup when speaking to a fund is whether they have capital to deploy or whether they're simply leveraging that conversation to raise their own fund, which there's nothing wrong for the investor to do, but from the founder perspective, they have to be very aware that it might be a 3-year process. And if they're raising in the next month and the fund is still fundraising, that might not occur and they may not be able to actually raise from them. And this is the diagram that we often talk about. And you look at the VC returns and you assume a 12% compound interest a year, which gets you a 3x, and 3x sounds very sensible, more than sensible, over a 10-year period. I'd hope to have 3 times my money if I'm investing in a VC. And then we look at the return profile, and of course we're reminded that the majority of companies, it's not that they fail, it's that they fail to exit. And therefore, the ones that do exit are typically a 1 in 10 and 1 in 20. And the key implication of this, of course, is that when a company is speaking to a fund, if they're not pitching a 30x return, they have a minimum, absolute minimum, 50, 100, preferable, they have absolutely no chance of raising. Why? Because if a VC invests in 10 companies pitching 20x, and if only one of those companies succeeds, a VC will be 20x the amount they invest, i.e. they'll 2x the fund. And that's not counting dilution. Dilution issues, other investors coming in, so actually the 2x might only become 1.5. And 1.5 is pretty trivial because it implies 2% a year or so, 2 to 3%. And I'd be better off putting my money in a bank, not at the moment, of course, but maybe 10 years ago. Might be putting my money in a public market, which goes back to my earlier point around types of investors. If you're speaking to a family office and you're pitching them a couple of % a year, they're better off putting their cash in crypto. What are the 5 asset classes really? Cash, crypto, real estate, public market, private market, and maybe gold. And so a typical family office will be thinking about those 5 allocations. And so your private capital has to generate sufficient interest, which is why in all the VC decks we see, most investors, of course, are pitching at least a 3x return. Now, before we move on to those implications, I guess to those in the room, what do you all, I know you've probably got conflicting incentives here, some of you investors, some of them founders, what do you all believe is the median return of a VC over a 10-year period? What X? Who wants to go first? Founders. In Europe, correct. Say again? Less than 2x, all right, that's a start. Any others? But all the VCs are saying at least 3x, but less than 2x, okay. Any other thoughts?
Well, that's the ambition, right? Well, I think that-
Well, the ambition is 5x. I mean, that's the minimum. It depends what your ambitions are, right? That ambition is 12% a year. Now, you get 8% a year in the public market. You know, PE's ambition is 25. So I wouldn't call this ambition. I'd call this the minimum. But it depends. It depends what you're pitching, right? In the UK, a lot of investors, and I'm from the UK, so I know a bit more about the UK than Poland, of course, is that many investors prefer investing in lower risk companies, lower risk, i.e. lower risk of failure, like, you know, let's say the B2B space, than higher risk, let's say the B2C space. So I think, I don't know, ambition is different for different people, but I'd say this is the minimum for some of the top tier. So we had 2x, what other X's? 3? Great. So the answer, of course, is, you know, the data isn't clear, but the survey and results suggest it's between 0.9 and 1.3. So depending on what report you look at, depending on whether you're looking at only the good ones, if you look at the total market, what we've researched and what we've seen is between 0.9 and 1.3. And what does that mean? Well, that means that a load of funds don't return the capital to their LPs. And therefore, why do you think that is? Well, the answer is, of course, that the VC market is investing in VC-backed startups. And VC-backed startups are exiting only 1 in 10 times. Therefore, if the VCs were investing in the startups, the VCs were investing in the exact same statistic of startups' failure rate, which means that the majority of VCs will fall in this category. 1 in 10 will return a crazy amount, you know, the Excel, Tomicos, maybe 8 to 10x. A couple of out of 10 VCs will return, you know, maybe 2 or 3x. But the majority, simply just working out the numbers, right? Startups only 1 in 10 succeed, 9 in 10 fail. The majority will be the 9 in 10, and obviously failure isn't failure, but the majority will be in this bucket of 1x and lower. And therefore, of course, VC is a top quartile game and a top decile game if you're playing it right. You want to be in that top 10% of investors. And if you think about it logically, it's not, you know, it's not a surprise. And actually, when you work through the maths, you realize from a founder perspective, if you're not pitching yourself to be in that top decile out of the other 10 companies they're looking to invest in, you've got no chance, because every single company has to have the potential to be in the top decile. And if you look at the numbers, the mean valuation exit is around 40 to 50 million euros in Europe. 40 to 50 million, right? Most of you investing at Series A at 10 to 20 mil pre. That's a 2.5x on the investment. And if all your investment made 2.5x, then great. But if only 1 or 2 make 2.5x, you're effectively making in total a 0.5x on the 10-year period, right? So those are some of the numbers that actually often surprises funds and founders, and, you know, some of the funds in the room maybe today as well. And these are some of the implications that we see. You know, the VC model drives everything. You're pitching to someone who's not making decisions on their own capital, and therefore that's why when we work with founders is, you've got to have this 5-year financial model. Why? Well, you've got no idea what happens in 5 years, let alone tomorrow. But most of these funds, you've got to show that to your LPs, you've got to diligence it, you've got to actually make sure you don't get fired, right? If you're an investor and a company hasn't got any modeling or any documents, even though they're an awesome founder, and if you invest in them and that company, the company fails, you're going to be the one to blame. And so there's an art and a game to this. The spending time with funds to have capital is something that I've talked about 5 minutes ago. And then lastly, this is often never fully taken advantage of. The value of founders to speak to the LPs and to build those relationships with the LPs. It's critical. We've just done a deal with a company. We just advised a company called Timeline that raised this week. And they had MTech, an InsurTech VC, right, as who was the lead investor. For MTech and InsurTech VC, they've got a bunch of insurers as LPs. I'm sure there's a lot of strategic synergies between the company and the founder and some of these big insurers, because they might be potential clients in the future. And so that's one of the implications, is understanding. If you can understand the LP mindset, you can actually better support and better understand how VCs work. And then the last takeaway, which I've probably got a minute to do, is FOMO. And FOMO, how are we building FOMO? Well, you're building FOMO because you're generating a sales process. And it's the same if you're a fundraising or if you're startup raising. The way you build FOMO is there's a couple of easy things you can do. The first thing you can do is send regular updates. Very simple. Every month when you're fundraising, if you're fundraising as a fund, you're fundraising as a founder, send an update every month which explains, a new hire, a new commitment if you're a fund, a new customer if you're a founder. Send an update every month. That's the first thing you can do. Second thing you can do to build FOMO is prepare your documents. If you're a founder, we spend a lot of time supporting the companies we work with building their financial model. For example, it might be 100 hours, might be 10 hours, might be 300 hours. Without a robust financial model, without a really good investor FAQ of the 10 most commonly asked questions, and without an IM if you're raising, without a teaser if you're raising as a VC, then it implies that when you get a question and it takes you 2 weeks to give them the model, that you haven't got the model, which means you're not speaking to anyone. Which means that there's absolutely no FOMO because the investor you're speaking to is the only one you're speaking to. Why? Because if I ask you for a question that's like, tell me about your competitors, and it's like, yes, thanks for your question, give me 3 weeks to get back to you, this person has no idea who their competitors are. So the second thing you can do is do the prep. And the prep is really important regardless of where you are in the cycle, regardless of whether you're a company or a fund. The third thing you can do to build FOMO is to leverage offers when they come in. So we never recommend founders to forward term sheets from investors to an investor, but we do recommend once an investor comes in with a term sheet to go round and circle back with everyone saying, we've received a term sheet, high level terms, it's 2 million at 10 mil pre. We'd like any final offers by the end of the week if you're still interested. Otherwise, we're looking to close with this particular investor. And that's something that's good to do because you can close off conversations, and there's something you can do when you're leveraging those offers when they come in. And the last thing you can do to generate FOMOs is to try and do it try and be a kind of non-cocky, arrogant founder, but imply that you're speaking to lots of funds. So how might you do that? Well, an investor might say, can you come and speak to me at 2 tomorrow? And you might reply, sorry, I've got another VC meeting at 2. What about 3? And if I was an investor, I wouldn't particularly think, oh, this is he or she is deliberately trying to play me off. I'd just say, he's got other investor conversations. Just a nice little easy thing you can say without building too much of a bad reputation. Because of course we hear lots of stories about founders going, waving 100 term sheets around, playing investors off against each other, and that's never a good thing to do. And so our recommendation is always do it in a soft, non-confrontational way to build a bit of FOMO. And actually, there's been some interesting articles by investors specifically about how to build FOMO. I think episode 1, a UK fund did quite a good one and also Frontline if you're interested. One of the partners, and they compared it. I think one of them they compared it to like a Simpsons episode, and they did like the whole fundraise from one particular episode, which is quite an interesting read if you're interested. So those are things to think about, right? How are you building tensions? Well, you know, the prep, the impression that there's lots of funds, because obviously there always are, and making sure that you're leveraging things as they come in, which I think, you know, for those investors in the room isn't something that is too, you know, I don't think it would put you off a founder, but it probably would put you off being sent a whole term sheet from an investor. You know, that's probably not really market thing to do. Cool. So that was what I wanted to cover. You know, a bit about the term sheet report and the results that we had, what a typical term sheet is. If you're interested in downloading the report, just jump on our website at Mountainside Ventures and look at our resources section, or just add me on LinkedIn, and we published it openly as a PDF. And if anything, you know, if you're a founder, who doesn't want to know what the market terms are? And if you're an investor and your terms are better than market or on market, then you can be that extra confident when you're pitching how much value you're going to give to the founders. You can say, actually, our terms are also market, as well as all this incredible value you can bring. And then I talked a bit about the investor docs that you needed, and of course, how funds work. Cool. Any questions before we finish off? Great. Well, I hope that now you all know what a typical medium VC return looks like, and how you can all strive for 5x if you're an investor.
Perfect. Thank you, Jonathan. Thank you so much. Thank you. You could just leave it here. We will take care of it. Thank you. Thank you guys for being so engaging. And Jonathan has finished a bit earlier than expected. And Catherine, our next speaker, will be available from 3 p.m. So I just suggest you go grab another cup of coffee. And for those of you who are online, take a second to get a break from a laptop screen and just let your eyes relax. I will see you at 3 p.m. with Catherine Batich. Thank you so much.